Hi, we are Afman Home Loan Group here. We're doing a series of videos to try to help keep people informed about what's going on in this industry. And today we have a guest. This is an old friend of mine. His name is Jim Kaiser. He's with Advantage Credit. Jim is an expert in all things credit reports. And so we're just going to ask a series of questions, Joel and I, and we'd like to just get some of your expertise, if you would, please. So the first thing we want to ask you, are credit reports that are pulled for mortgage lending purposes different than other credit reports? In other words, a lot of people think they have one credit score. And could you kind of talk about that a little bit?
Right, that is a little bit of a myth today, because when people think of FICO score, they're probably most often referring to their mortgage score. But for example, if you go online and buy your FICO score online from myfico.com, places like that, that's actually a personal FICO score. And in most cases, those FICO scores can be extremely high. They can be in the 800s. Let's say you pull your personal score and it's 820. And then you come in to apply for a mortgage loan, that FICO score could be as low as 680.
Right.
And because the algorithms are different for a mortgage FICO score versus a automobile FICO score or even a consumer FICO score. So they are different.
Okay.
Jim, which is worse, no credit or negative credit?
So, you know, it's surprising to find occasionally we'll see a credit report that has maybe 2 collections on it, and that's all with balances, and they'll actually have a FICO score because of balances on the collections. If you have no credit, obviously you're not going to have a FICO score. In my opinion, I think it's better to have no credit and start from scratch, and then build your credit with new, good quality credit versus having anything derogatory in your account.
And there are ways that we as mortgage lenders can use what we call alternative credit too. Whereas if you don't have a credit score, we can build that with other sources, but it's a little bit more difficult. But yeah, you're right. I mean, some people don't have any credit scores and they wonder, is that they don't know if they can get a loan or not.
Right.
So if I'm a consumer and I've got a collection, should I pay off the collection to the agency, or do I pay off the original creditor?
Anytime you have a collection, you should always pay the collection agency if you're going to pay off that collection. If you go back to the original creditor, they've already sold that to the collection agency. So if you pay off the original creditor, there's no guarantees they're going to go back to the collection agency and say, oh, by the way, we've got extra money to share with you.
That's right. Yeah.
Exactly.
They've got their money, right?
Exactly. And what's actually affecting your score today is the collection. So you definitely want to approach the collection agency and pay them. And then keep in mind that anytime you pay a derogatory item, sometimes it brings the date forward on that derogatory item. So occasionally if you pay a collection, it actually could lower your score initially.
Right.
Yeah.
Right. Okay.
Will paying off a collection account remove it from your credit report?
No, not necessarily. The statute of limitations is 7 years for collection. Now, medical collection companies are becoming more willing to work with customers that maybe were completely unaware that they had a medical collection on their credit report. So you pull the credit report, you probably have seen this, and customer says, I didn't even know I had this $78 medical collection, I'll pay it right away. And what we advise customers to do is call that collection agency and possibly negotiate. If they pay that collection, quite often the medical collection company will be willing to remove it before that 7-year period as well, which can help improve the score.
Right. If it's not there, then it doesn't affect anything.
Exactly.
Okay. All right. Great.
Yeah.
So why, of course, you've got the big 3, Experian, Equifax, and TransUnion. Why is it that sometimes they have different information and different scores? Why are there 3 different credit scores if they're all supposed to be using the same stuff?
Right. That's a great question, and they all use the same scoring model from FICO. They actually have their own unique name for their scoring model. There's a Fair Isaac version 2, Beacon, etc.
Right.
But they all use the same FICO score. The difference is that when a creditor reports to the bureaus, to all 3 bureaus, first of all, they don't have to report at all. So it actually costs companies money to report to the bureaus in the first place. But in addition to that, they're not required to report to all 3. They may report to just one. Collection companies, for example, quite often will report to maybe just one bureau. So you may see a FICO score, 700, 700, and then there's a 580. And you probably know that that's probably where the collection was reported, and it wasn't reported to the other 2.
Okay.
Yeah.
That makes sense.
Yeah.
Jim, is it a good idea to close old revolving accounts no longer in use?
You know, for the mortgage FICO score, one of the key factors is what they call the perfect or healthy credit mix. And so for the mortgage industry, you want to keep at least 3 revolving accounts, active revolving accounts on your credit report. But in addition to that, you should have maybe at least 2 installment loans. But on top of that, you can even have additional credit cards that you have with long payment history that you pay off every month with, you know, 0 balance. So I always encourage people to, you know, if you have 5 or 6 credit cards, it's okay to keep them all open.
Mm-hmm.
You know, keep at least 3 of them, you know, where you pay them off every month. Keep the other ones with low balances. And but if you have someone that says, well, I've got 10 credit cards and I want to close some, I always recommend they close the ones that they've had the least amount of time with.
Right.
Keep those ones open with the long payment history.
Okay. So how do you recommend that a person monitor their credit on a regular basis?
You know, that's something, if I had to promote throughout the industry, that I wish everyone was doing, and hopefully it happens.
Yeah. Well,
you know,
hopefully this will help.
this
Yeah.
will help today. I'm telling you that if you're thinking about buying a home a year from now or 2 years from now, or doing a refinance in the future, the best place to go is annualcreditreport.com.
Okay.
That's been created by the 3 bureaus, TransUnion, Equifax, Experian, and it's there to provide, customers can go in or consumers can go in, you can pull your credit for free every 12 months from each bureau. And it's a great way to monitor your credit.
Mm-hmm.
So if you're thinking about doing that purchase in the future, don't wait until the mortgage company pulls your credit. Go in and pull your credit 6-12 months in advance. Take a look and see if there's any surprises there so you can maybe correct those before you come in to apply for a loan.
And another person that you know, Mindy,
Right.
At your company, has also recommended that you use this, and then you pull like every 4 months, you pull one from Experian, and then wait for 4 months of TransUnion, and then another 4 months, so that every 4 months of that, you know, every third of a year, you're getting that information from one of the bureaus. Okay.
Free credit monitoring throughout the year. Yeah. You learn well.
I do.
So Jim, if a potential borrower is planning to purchase or refinance soon, what recommendations would you have for them prior to that transaction?
You know, obviously the monitoring of their credit or pull their credit report through annual credit report would be a good start. I think the next part is do they have that perfect or that healthy credit mix? Do they have the 2 installment loans, the 3 credit cards? We occasionally will find, I'm sure you've seen this, where someone doesn't want to borrow a lot of money, they don't want to borrow credit. And well, part of getting a mortgage is you have to prove you're credit worthy, and you can make your payments on time. So if you have maybe just 1 credit card, I'd recommend you go out and open up that 2nd or 3rd credit card. Make sure when you get ready to apply for a mortgage, you have at least 3 credit cards or revolving lines of credit open, and that actually will improve your FICO score. So a lot of times people think by opening up a credit card it's going to lower your score, and that can happen if you already have those 3 accounts, but if you don't have enough accounts open, go out and make sure you have at least 3 open.
Because we've actually had people we've pulled a credit, or I pulled a credit report for, and you know, they think they're supposed to have very good credit because they pay cash for everything.
Right.
Well, again, part of it is the history, and so that's important.
Yeah, exactly.
Well, thank you so much for joining us, Jim. And again, this is the Afman Home Loan Group, and if you have any further questions regarding credit or how we might be able to help you with credit in regards to a refinance or a purchase, feel free to contact us. Thank you.